All right, good afternoon, strategic traders. And this is Brian, and we're going to have a quick rundown and recap of yesterday's trade and where we stand at today and how we got here and what this all means. Now, yesterday we started with our insurance trade, Euro Pound, and we were buying Euro Pound at 88.80 and selling at 89.40, and we have $25 of risk and $25 of reward and $75 of risk on each ticket. This is the optimal price range that we want to have for each of our contracts, but insurance trading will guarantee that we will make coverage costs no matter how much you pay for the contract. But our system requires us to put it in this because we have two methods of making profit. One at expiration and another by closing out at the strike price. And I'll show you what that means as we go forward. Now, once you place your options, this is what we have. This is the situation that it looks like. We have 89.40 and 88.80 respectively. And as you can see, this position is a winning position off the top for both of these contracts. You start off with two winning contracts, and the idea at the end of the day is you want to have one at least still in that position and the other neutral, if not in profit as well. So this is the game plan, and as we move forward, we have placed our insurance. Now let me show you how we did this and how we chose this level of insurance and how we came about this. Pause this. Now, when we start insurance trading, there is two methods. There is the fully managed account and there is the insured account. The insured account is an account that is just that. It is insured, but you, the trader, are going to be managing that account. Now, if you wish to be an investor and just collect the profit from this, you then will take a fully managed account. But let's just say for this example, you are a trader and you have a managed account. Your fee for this account is $250 a month. Now, that might seem like a lot, but you're going to see where that money goes and how it is well placed and how it makes you a lot of money. Now, going back to our previous trade, we have the Euro Pound and we have two contracts worth around $80 of risk. And one of those sides, if it ends up out of the money, is going to cost us $80. So the $250 that is deposited with us is placed in a spot forex managed account like the one that you see here. And $228.61 for this currency pair must be put into margin, and the remainder can be traded at a rate of $12.85 is what they a pip, $12.85. So if you have $500 or $250 in this position, and we're covering you, that premium that you have supplied us with is what we use to put in margin to place the entry orders to get the trades that are going to then cancel your loss out. So this is where this goes every single month. And let's do some quick math real quick. If you put up $250 and your first trade back saves you $80, well, the fourth time that happens, you can look at it as if you have made your money back. It is going to be impossible for you to lose that month because you have now covered your entire trading position with the money that we made. So this is a great method to protect your capital and grow your account. So let's go back and see how this looks like once we place the actual orders. And here we go. So you can see now we have an entry level that is 10 pips above and 10 pips below the strike cost of our options. And also, as a risk to reward feature, we place our stops the same distance as we place our take profit. In this case, it'll be 10 pips. So with a 50 pip range, we have 10 pips down, 10 pips up, and 10 pips in between that act as a neutral zone. And that is the setup that we will have every time that we go into one of these trades. Now, how did we fare? Let's look at what happened during the night and during the rest of the day. We see that looking at our chart, price actually did fall down, entered into our insurance, breached the bottom level strike, and then rebounded back up into its position. But this is actually a very positive situation. This is the situation that we actually want. We're covered in this, and we have already generated the funds in case the price does fall back down. We have everything covered with this particular position. And how did it work out? Well, let's see. We have $7.50 in the negative currently, and $12.25 in profit on the other. And this is with some time to go. We have like 4 hours left on this one when this snapshot was taken. But one of the things that you need to remember about binary options, and that actually is three things: 0, 100, and 50. 0 is how much you make if you are wrong. You make $0 on the option. $100 is what you make if you are correct. And at the strike price, no matter how much you pay for that option, at the strike price, if price reaches that level, your option is worth $50 because you have a 50-50 chance either way. So if you paid $75 for your option and it falls or rises to the strike price and you have a $50 loss, excuse me, $25 loss is what you have on here. And if you closed out right now, you would be negative $25. How do you get that? Because you paid $75 for it, and it's reached the strike price, and your option is now worth $50. So you would close that out, and that would be a loss of $25 on that side. Now, should the other side remain in play, and it is profitable, you will make $25, and the entire trade cancels itself out to nothing but the transaction cost. So this is a very good method that we use when we have a fully managed account. We're able to take more trades during the day because we're not holding to expiration. We're closing out at a smaller profit, but at a much faster ratio. Now, as a trader, we have to hold to expiration because the coordination level, the logistics of opening and closing, and that is going to be left up to who we are as traders. So to automate that system or get it all to where everyone is on the same footing when it comes to when to open and close a trade can only be done if we open up at the same time or hold to expiration. So that's why we do that as a function for traders. All right, now moving on. Okay, you see, our $226 gives us $12.86 a pip, and the price fell down significantly. And here is how the insurance played out with our spot forex. We entered into the trade at 88.90, and we're selling down to 88.80. Those 10 pips, and we're selling at a rate of $12.86 a pip, and we got 10 pips from 89.90 all the way down to 89.30 all the way down to 88.20. Okay, and we got 10 pips, and that was a total of $128.80. Now, why did we choose that level? because this is a business. And this is how our profit is generated along with yours. By generating this insurance at this level, we are able to then, if necessary, pay $75 out of this trade and reimburse you for the price of the ticket that was lost. This method is done mathematically, and it is done um, with the easiest of simplicity, because we can handle multiple, and I mean multiple forex trades in this manner. As option traders, there is the logistics of opening and closing your own trading account and your own contracts. So that is why, as a trader, you will only be able to be covered for one or the other eventuality. It will be either yes or no. It will be either $100 or zero. But as an investor, you would be able to profit more along the lines, because we are going to, as I said, close out at the strike price, and that will be a loss of $25. Well, if I've just made 128 and I have to close out at $25 loss, over here, we've already made that. So now the other contract will brand good, and we will hold it to expiration. So that method of closing out at the strike price, if you are a trader with the account that we're trading for you, we would recommend that you move up and become an investor and let us do that for you. Now, we'll see how it works in action in just a moment. Here's what it looks like all together. We have a total risk of $75. And as you can see, at the strike price, it is currently showing a negative $25.50. Okay. And our other one that is in profit right now is in profit at $16.25. Now, we can hold this one to expiration. It's one side and let it generate its full profit potential, or we could close it down right now, the entire position, as one. And with our insurance of $128, that's a win-win-win all the way around. This method of trading will guarantee a minimum of one side being profitable, and the other side, if not profitable, not harmful. So this is a way to trade more consistently and to profit almost on every single trade, the 100 plus win rate system. And this is where we're going to pause right now, guys. I'm going to stop this, and I'm going to post this video in the group along with the links to it. And I want you all to, if you have any questions, comments, criticisms, concerns, please feel free to reach out to me 24/7, and we will address them. So here you go, guys, and I'll be dropping this in the group in a minute, and I'll talk to you then.